subscribe now and press the bell icon. Never miss an update.
Okay, so let's get started. This is the last topic of chapter 5th. Right now we are again focused on only like the deductions which are made in order to arrive to taxable income. So we saw there are certain standard deductions or itemized deductions, and we went over some items for that. 1 minute. So we went over what are the tax deductions that we can take: property taxes, state taxes, or mortgage interest, or donations. Last time we talked about charitable contribution and that stuff. Or there's some personal and casualty losses. Right? Those are all called below the line deductions because those all deductions come in after AGI is calculated. Okay, now, so there are only two deductions after AGI. Anything that goes under Schedule A, which is itemized deductions, or if you don't want to go for itemized deduction, just take a standard deduction. Now, below that, there is another line item which is called QBID, Qualified Business Income Deduction. There are only those two lines. So again, if you follow the structure, think about it. First, we have gross income part. Then we have adjustments, which is above the line adjustments. That could be, we talked about, those are self-employment health insurance deduction, or IRAs, or self-employment taxes. There is a 50% deduction for self-employment taxes, right? If you remember, we went over all those different items. After doing all of that, we came to AGI, adjusted gross income. Okay. Once again, we add up all kind of income. It could be wages, interest, dividend, capital gain, K1 income, rental income, whatever it is. We add up everything. Then we do all above the line deductions, which I just mentioned, and then we come to AGI. After AGI, we will still see, are there any more deductions that the taxpayer can take? Our aim is to give as much deductions as possible so that tax liability goes down. So then we will look into standard deduction or itemized, whatever is beneficial for them. Because not everybody will have a house. So if they don't have a house, they don't pay any mortgage interest, they don't pay any property taxes. Not everybody likes to donate. If they don't have any charitable contribution, say, which is crossing the standard deduction limit, then there is no point going for itemization. So there is always two options given to taxpayer. That, see, if you have a lot of those, we have certain clients, those who have donated $60,000 or $80,000 a year. In their case, clearly there's nothing to even think about. We clearly have to go with itemized deduction. And if they don't have itemized, then standard is something that will come automatically in the software, and the limits are changing every year. It's kind of like $25,000 or $26,000 for married filing jointly. So up to that, we have covered everything. Now we're talking about qualified business income deduction. What does that mean? What is qualified business income? The name says something to do with business. What is qualified that we don't know, we will go over that. And it's a deduction. That means it's going to deduct your AGI, or it's going to reduce your taxable income by a certain amount. So it's a deduction. It's not an addition to income. So now we'll see what is QBID. So one thing that we need to understand is QBID is related to pass-through entities. Please make a note of it. Only pass-through entities. If there is a S corporation or a LLC or a partnership or a sole proprietorship that the client has, then there is a good possibility that QBID deduction will come up, or QBI deduction will come up. If the client does not have any business income, or the taxpayer doesn't have business income, then we are fine. Maybe this will be just a blank line. It's not even applicable. There's so many people, those who don't have any business income, they have just salary income and they have investment income. In that case, this is not even relevant. So let's look into the history of QBID. What is that? This is a relatively new kind of deduction which was introduced by this Act TCJA. Again, we saw Tax Cuts and Jobs Act. This is again something that Trump government has brought in. And what they did is, we have talked about this earlier also, that the Republican Party always want to reduce the tax rates. Okay, if the Democrat comes into the power, there is a right now there's a Democrat Party ruling US, right? Joe Biden is there and all. So again, there is a big fear. There is a fear that the tax rate will go high, because there's like a lot of these speculations happening, or there's a lot of these things that, okay, right now the corporate is 21%, maybe they'll make it 30% again. The income tax rate is going to go high. And this may happen. It always happens. So we'll have to see what it does to economy and all those things. But anyways, what I'm trying to say is TCJA was introduced and corporation tax rate was cut down from 35% to 21%. That was a big, big cut. And everybody, obviously, all corporate, the entire US corporate, all the inks and all business community really, really appreciated that, because you see the business, it's not like 1 or 2 points cut here and there. So now when the C corporation tax rate got cut or got reduced to 21%, there was a natural question that came in from individuals saying that, okay, if it's a C corporation, they're paying only 21%. I'm running a S corporation, or I'm running a LLC, or a partnership, or a sole proprietorship, and why do I have to pay still 35%? Why is that not getting reduced? So Congress understood that, and they said, fine, yeah, that whatever you're saying is making sense. So what we'll do is, we cannot reduce your tax rate and all, but if you have a business income which is coming from any of those pass-through entities, we will give you a deduction. We'll give you a very significant deduction. Effectively, what that deduction will do is, it will reduce your tax rate, effective tax rate. You will still, if you're falling in the bracket of whatever 25%, you'll pay 20, the tax slab will be 25% only. But if the taxable income is getting reduced, your effective tax rate is also reduced, right? Your tax liability on the total income is low. So instead of cutting down the tax rate, Congress said that what we'll do is, we'll give you a good amount of deductions. Okay, what did they do? See here, sole proprietors, S corporation and all, they did not want to disadvantage owners of these entities, and they said that we will reduce this burden by creating QBID, because potentially they were paying 37% as compared to C corporation, which was paying only 21%. And both of them are running business, right? So why there should be this discrimination? Why they should, just because you're having a S corp, you have put them into a disadvantageous situation? They're also providing support to the economy. Even S corporation, C corporation are also generating jobs, giving generating profits, giving more tax. They're helping in the growth of the nation. And sole proprietorship, S corporation, partnerships are also doing the same thing. It's just that they have different tax structure. So that is the whole history behind this. So every time now, the whole point why I'm telling all this story is that whenever you are working on a K1, or you're working on a S corporation, okay, or any of these pass-through things, it should come to your mind immediately that, okay, what about QBI deduction? Did we take it? Can it be applicable to them? Do they satisfy all the conditions? If we have that knowledge, we can go into the form and we can see, oh, maybe we have to checkbox this category where it says QBI, and then all the deductions will come in. If you don't even have knowledge, the form is right in front of us, we just go through it, and there's something called QBI written there. You probably don't even know what that is. You'll just ignore it. It's like, okay, fine, just ignore it. No idea what that is. Right? So it should come to our mind whenever we are working on, there will be a lot of S corporation returns or pass-through returns that we will see them coming in. At least in our work paper, we should write this question: what about QBID? Why is it not showing up? And there could be valid reasons why it will not show up. Okay, but at least we should look into that possibility. So anyways, this also point we covered. This is the last deduction before we come to taxable income. That's what I was explaining all of that above. Now for QBID, to calculate that, what the government is saying, that you divide the business into two different categories: a specified service and then qualified trade. Okay, specified services, they're giving example, they for simpler way, and for not to be able, like, not calling out the entire big name, so we'll just call it as SSTB now on. So for SSTB, which is specified service, there are different conditions. For qualified businesses, which we call it as QB, there are certain other conditions. So the entire, all those S corporation, all the businesses are divided into these two categories. So in the tax form, when you're filling that up, it will ask you, there will be line items there, that whether this is a QBI or specified or SSTB. We should also understand the nature of the business. That's why it makes sense to ask all these questions to client. What the client may just tell you, hey, I have this ABC LLC. This is the K1 issued. How will you know what this ABC LLC is doing into? So we need to ask, okay, what is this ABC LLC is about? Are you providing some consultation services? Are you providing some software development? Are you into real estate? Are you into construction business? Are you into trading? Are you into financial services? What exactly this ABC thing is doing? Once we understand the nature of the business or nature of the services offered, then we can mark the right category for that. Typically, SSTB is a business or trade where using the skill or a reputation of the person or the firm is predominant. So any business that needs, now if you're like buying and selling something, you set up a grocery store, you get all kind of stuff, you're just sitting there, and then somebody comes in and you said, okay, give me this cheese, give me bread, give me this and that, and you are giving it. Okay, we have a margin there, we are making profits. There's no skill required there. I will not get deeper into that, but broadly speaking, there's no skill required. On the surface of it, there's no skill required. It's not like you need to be a chartered accountant in order to do that. No, anyone can do it. But in order to sign the audit report, yes, obviously you need to be a chartered accountant. In order to sign a valuation report, you need to be a certified valuer. In order to give prescription to somebody, you need to be a doctor. There has to be a proper license, degree, everything. So that is called skill-based business. So and those are more of professional services in nature, right? Because we are kind of mastering a profession, and that's what they're saying. Health, law, not everyone can practice law, right? Accounting, although it's different. In India, you will see all the people practicing medicine, even if they're not doctors. And even you ask, and they will definitely give you an advice, not even charge you for that. Okay. But accounting, actuarial science, arts, consulting, athletics, there's some of the examples that they have given. There's some kind of skill required. And the principal asset is the reputation of that person who is running the business. Financial services are also included there. Then brokerage services, yes, because again, we need some kind of license there. And typically for all of those things also, some license may be required. Then there's another thing is where the reputation, we are also talking about the reputation of the person. So if somebody who's very popular and that person is said to be the, um, that person is said to be the face of certain brand, like how Adidas will have probably sign up with some athlete, or some L'Oreal will have some TV actors or like movie actors come and sign up and all those things. So that way, if any appearance fees are there, any likeness, image, name, or endorsing products or services, even they will fall under SSTB. And there are certain businesses which are not considered, which are architects, engineers, real estate, insurance agents. I mean, one can argue that why architects, engineers, they're also professionals, right? So it should go under SSTB. And they will also probably need a license. If you're a civil engineer, you're like trying to do construction and all, probably you'll need a license or something. Right? But for some reason, they're not considered as SSTB. Real estate agent and broker, insurance agent and broker, that we can understand, even though there are certain exams that people in US need to write in order to become a real estate agent. Not like anybody can go and there say, I know a buyer, I know a seller, and I'll make you meet both of you, do the transaction, give me my commission. That's what it happens here. But there, people have to write an exam, get a proper license, even if you want to be a real estate broker or an insurance agent and all. And then only you can get into that business. But these four are not included. Any questions here? We'll just take a quick break and open up for questions. Anything that you're not able to understand? What is QBID? What is the background? What is its purpose? But in general, again, we can get an idea. Anything which is related to a profession can go into SSTB. And brokers, these brokers are not going, but there is a financial broker, financial broking services, that will fall under SSTB, but not real estate or insurance agent broker. Now let's see what are qualified trade or business. So anything which is not falling under SSTB will be qualified trade, because there are only two categories. Every business has to fall into one of those categories. So anything which is not going as SSTB, which is not satisfying this condition, will be considered as qualified business. And how to calculate the deduction now? Typically, like, we need to remember that 20% is what you just take the income. If S corporation income is $100,000, $20,000, 20% of that can be taken as a deduction. That's a very, very straightforward rule, like on the face of it. But obviously, there are going to be ifs and buts there. If the person is having capital gains income, then we have to do some calculations, okay, in order to factor that in. Now, why? Because capital gain is anyways taxed at a lower rate. And IRS is giving that QBID advantage only to reduce your effective rate. So what IRS is saying, if you're having a long-term capital gain or qualified dividend again go with 15% tax rate. So you'll have to, take that out. You don't have to consider that. Now, why are we even talking about considering that or not considering that, right? Why am I even, like, this question may come to your mind. Why am I even talking about that? The QBID is just take 20% of K1, right? So how does capital gain matter? How does dividend income matter? Correct? If you're thinking that way, I think you got it right. So, but there is a rule here that we have to see, that overall limitation is the lesser of 20% times qualified business income. This is typically the K1 income or pass-through. And they're saying it has to be lesser of. You take 20% of taxable income minus net capital gains. So we'll have to see if the taxpayer has net capital gain, the taxpayer net capital gains decreases his or her QBID. So for this deduction, net capital gains are long term. Okay, yeah. So what we are saying that capital gains, we're talking only about long term gains and qualified dividend. Minus, you can deduct those losses also. The losses are getting deducted from long term gains only. Okay, all short term losses. But that's what, because this is already coming up at a lower rate. So again, this calculation, we are not doing it manually. When we are doing a Schedule D, when we are doing Form 8949, we are already telling that these are my capital gains. When we put in Form 1099 div, it goes there and sits in the system that these are total qualified dividends. Now we are not manually doing this calculation. This is, we just have to put correct number, correct places. This is will software will do, saying that, okay, if there are capital gains and qualified dividends, it will do this calculation also. See what is the number coming. What is the number coming as per this calculation? What is lower of these two? That you will take as deductions. Okay. So what they're saying is there are basically 3-step process to calculate the QBID. Wait, let's read this. Before a taxpayer can apply the overall limitation, he or she has to determine the combined QBID before the taxable income limitation. So we have to see what is the combined QBID. So anyways, we'll not go through very much in detail, but let's go through these steps. Step 1 is every pass-through entity must first determine its QBI. If there are 5 S corporation that the person has, or 2 S corp, 3 LLC, whatever, there might be different pass-through entities. On a Schedule K1, when we fill it up, we mark that this is a QBID and all. So we'll have to first figure out. Then we'll have to take the sum of each pass-through entities and test it against the taxpayer taxable income. So if the taxpayer's income is very high, again that phase-in rules will come up. If the taxpayer income is lower than certain level, the entire deduction can come in. If the taxpayer income is in phase-in range meaning some middle range. Say below $100,000, everything is allowed. $100,000 to $200,000, that's called phase-in range. There will be some limitation that will come in. So your deductions may be reduced. And then above $200,000, say nothing will come up. Okay, so there is a phase-in range. And what they're saying is for single taxpayer, this is the range. For married filing jointly, this is the range. Okay. So QBID for each respective pass-through entity is reduced or limited by the IRS. Again, that's important. We should underline this. It may be limited by IRS because what they're again saying is, see, as again, this is now a very common rule. As and when the income increases, the deductions will go down. For the highest, when the income increases and the income increases very high and all as per IRS standards, what IRS thinks that anyways, these people are very rich, let them pay taxes. We will limit their deductions. Let the deductions go to people who are earning average money or who are earning lower, threshold money, so they can get the best benefit possible. So that's why they have put in some ranges here. That if your income, if a person is married filing jointly and the income is going above this thing, then the QBI deduction may not be just 20%. It will be different. Okay. Then what we'll do is we'll determine the applicable combined QBID we'll add up all the QBID and all, and we'll have to see what is the overall limitation that we can apply. Okay, so these are the 4 steps. Again, what they have done is they have put up all 4 steps in this table First of all, we have to see what are the pass-through entities. Then step 2 is whether the entity is directly owned, whatever, like by the taxpayer. Yeah, these are different steps. They are saying what constitutes QBI, what is qualified business income. So what is qualified business income? First of all, we'll see if there is a pass-through entity, okay, in their tax returns and all. Or if the taxpayer comes and tells us, well, I'm a owner of so and so S corporation, I have a LLC in my name and all. So that gives us an idea, oh yeah, they have a pass-through entity. Second question that comes to us is, if we are working on their 1040, that where is the K1 from your pass-through entity? You said you are an owner. Did you give us the K1? K1 is your partnership share. So let's say the K1 has also come in. Then we will do all these net income gain calculations and all, and we'll see what kind of deductions are applied to them. Again, what we have to see that the amount is, this K1 is coming from United States. You cannot take a foreign income for that. So person might be having a foreign partnership and all, but that's not allowed. Okay, this has to be a US business. And we have to remove the following from the calculation of net income. What do we have to remove? Capital gains, dividends. Again, these are all net capital gains, meaning long-term capital gains less short-term losses and all those things. We are not removing short-term gains from here because short-term gains will come up at the regular tax rate. Any kind of dividends, or there's some non-operating interest income and all, but they have a less that you have to remove all these amounts and calculate the net income. And this is the same method used to determine income from SSTB. SSTB is specified service business. Right? So same method we will use there. One of the very important criteria to get QBID is to make sure that person is getting paid some W2 income from that particular pass-through entity. To give an example, let me just put something here. To give an example, okay, let's say there is a K1 of 100K coming from an S corporation. No payroll run. No payroll is run. No payroll is run for the owner of the company. So entire 100K is just coming as share of profits. Now what happens, why people go for S corporation? There is an advantage that S corporation do not pay. There is an advantage that S corp K1 income do not pay self-employment taxes. Otherwise, why do you want LLC to be converted as S corporation? Just stay with LLC, na? Why do we have to go and tell IRS that no, I want a S corporation status? Both the cases it is passed through only. Why do you want S corporation status? Because S corporation gives this advantage. So there is a saving of almost 15%. We saw that this is what self-employment or payroll taxes are. Self-employment or payroll taxes. Who remembers what is this 15% comprising of? Go ahead.
Is it Medicare and Social Security tax?
Yes, yes. I think that's what Anurag said. Medicare and Social Security. So that's 7.5% being borne by employee, 7.5% being borne by employer. But now there is no payroll only run. So where is the payroll tax? There's no payroll run, so there's no question of payroll taxes. Fine, okay, no payroll run, no payroll taxes, agreed. But there has to be then some self-employment taxes. That is going to be the same percentage, but then S corporation gives that benefit, no self-employment taxes. So what IRS is saying that you have to compulsorily run payroll when you are having a S corp. This is the advice we should also give to our clients, that if you are having a S corp, if you are having a a decent amount of income coming from S corp, please make sure you're running a payroll. This is a mandate from IRS. Why you have to run payroll? You can tell IRS, why do I have to run payroll? I'm getting S corporation profit, I'm paying the taxes. Then IRS will tell you that yes, you are doing that, but we are giving you an advantage. No one is asking you to pay self-employment taxes. So you can, now today it is $100,000, tomorrow it could be $1 million, tomorrow maybe it could be 500,000, 5 million. So you will take $5 million income on such a small tax rate, because you're not paying 15% is right away going out. I mean, you're getting advantage of that. That's a big saving. So you better run payroll and pay social security and Medicare, at least if you're not paying income tax. And that's what the requirement is. Obviously, if the person says, well, yes, I have a S corporation, at the end of the day, I'm making only $5,000 from that S corp. What payroll will run in that $5,000, right? That's like, so there has to be some reasonableness also. IRS is not saying any amount of profit you have, you run payroll, because it's not practical. What the IRS always use the term reasonable. Reasonable amount of payroll needs to be run for a person. Maybe what your industry says, what are the trends there in the industry. If you're making $1 million from your S corporation, you're running a payroll of $20,000, that's completely unreasonable, because you don't want to pay payroll taxes. You're kind of decreasing your payroll as much as possible. But if you go out in industry and work, and if you really have the ability to generate an income of $1 million, maybe somebody will hire you at a salary of $100,000. So you should at least pay yourself $100,000. So it's not, no limits have been given by IRS. It's just our professional judgment, our reasonableness. So we always tell client, that make sure you're running a reasonable amount payroll. Don't try to push out every income through K1. There has to be some reasonableness there. And that is one of the condition. Now, why I'm talking about all these things when we are talking about QBID, what relevance does it has? I'm mentioning all that because QBI deduction does not come up if you don't run a payroll. There's a little box there. It will ask you how much is W2 income. If you put in there, it will calculate that okay, you are paying enough self-employment taxes or payroll taxes, you should get some QBI deduction. I think they talked about somewhere about payroll also here. I'm not seeing. Somewhere they must be talking, or maybe below somewhere. But this is one of the requirements. The payroll has to be run. And the reason I could have just said the payroll has to be run, but why we are explaining all these things, why we are going again through all these things, because by not running payroll, we need to understand we are paying low taxes. We are completely not avoiding these taxes. We're not paying it. And IRS is smart enough to understand that why the person is not running payroll, because they don't want to pay social security and Medicare and all. And anyways, when the person grows old, social security will be given. So the person is saying, well, I have paid social security for 10 years. Now it's my own company. I can do whatever I want to. I will stop my payroll completely. No social security taxes will be paid out. No Medicare. And I can take all income for myself. But if that person was working as an employee somewhere else, there's no choice given to that person. You have to pay social security and Medicare. So IRS is saying there is also, we are giving you flexibility, but at the same time, there is also responsibility on you to run your normal payroll, so that you are giving your share of social security and Medicare, which is going to social security pool. After 20 years, when you retire, when you grow old, and when you need medical services, you should contribute to all of that, because government will give you free services. Who will pay for that? You're making good amount of money, pay at least some payroll taxes, right? Otherwise, poor people, those who are just having employment, they're making maybe $30,000-$40,000 a year, maybe less than that, $20,000. They are forced to pay, and you're making $1 million and you're not paying. That's very, very unfair, right? That's why all these rules have come into the picture. Otherwise, people, they'll just form their own companies. Rich people, they have a lot of money, they know how to do all these plannings. They'll form their companies, they'll like put everything through K1. Normal regular public don't have all that choice. They are just looking for a regular job and they don't have any say on those jobs and all. They have to pay taxes. But all these corporates and business people and all, they will just manipulate it. That's why there are all these rules made, that you have to run payroll and make sure you're paying something there. Otherwise, if IRS starts auditing and they see a S corporation with $1 million K1 income, no payroll run, you're into trouble. Then they will come up with any amount they want to. Then they will say no, 250,000 should be your payroll. There's no way you can explain, no, my payroll should be only 100,000. Don't increase it to 250. So it's better we only do some reasonableness and put in there. So at least when IRS receives the tax return, they can immediately see that, okay, there is a S corporation income. At the same time, this person is also running a payroll for themselves. At least it will, it will get passed on. Like it will not go through the scrutiny. So okay, so here they're talking about lower threshold, phase in, and upper threshold. We saw this limit 421 or something here also, right? Married filing jointly, correct. Married filing jointly 421 limit. It's the same thing that they're talking about, that if there are 3 different thresholds, how much QBI deduction you can get. Again, we are not doing all this mathematical calculation on our own when we do the tax returns, but we should know the rules. In some places, you will see complete 20% of K1 is coming as QBI deduction. Some places you'll see only 15% is coming, 10% is coming, or nothing is even coming. Why is that? Okay, so we'll stop here. Aggregation rules we'll do later. Aggregation meanings like aggregate all of them. If you're having more than one business, we'll probably aggregate all of that. And we'll also take into account the family who's running the business. Again, these people what they'll do is like they have 4 family members, okay, 10% your name, 20% another person name, 30% another person name, and they try to split up the income. So what they're saying is we will do all this aggregation rule for the entire family and see what is allowed, what is not allowed. And if the family owns more than 50%, then you'll probably get the deductions and all. But these rules are not applied to SSTBs, because SSTB, they don't even get that big benefit and all. Yeah, see, W2 is really needed. If W2 is taken into account, then only QBI will come in. But I just have a quick picture here. We'll go over that. Can you all see my screen? Is it visible?
Yes, ma'am.
Is it visible? Is it clear?
Yes, ma'am.
So kind of made it more visible. See, we'll just quickly go over that. What they're saying is there are 3 different thresholds. See, that's what the limit we saw. If it's single person less than 157, married less than 300K, then there is a phase-in range, and then there is upper threshold. If your income is above $415,000, you are into upper threshold. So what happens if you are into lower threshold? Qualified business or SSTB, you'll wait a minute. What is this saying? Any QBI income from either this. I think, did we miss on something? No, typically no QBI. Oh, yeah, obviously. Sorry, I am not reading it properly. So what they're saying is any QBI coming from income coming from these 2 kind of businesses, yes, if the income is coming, you will get full deduction. No, obviously, then there is no deduction. Phase in range is very important here, because here the income is getting phased out, or the deduction is getting phased out. So what we are saying is here we will see what is the W2 wage limit test. We have to do the W2 test, whether W2 is issued or not. So payroll is there or not. Okay, and then certain applicable percentage will be there. Then we'll have to take the W2 limit and all certain formulas they are applying, and based on that QBI will be calculated. It may not just be 20% and all, it could be like all these steps we need to follow. So there has to be a W2 wage limit test. If you are having an income of $1 million, running a W2 for only $20,000, the W2 is not meeting that test. The W2 limit is greater than 20% QBI and all. It's going to be very less than 20%. So we'll have to see those things. Now, third, what is happening is upper threshold. If the income is so high, then if you are having an SSTB, there is no QBI allowed at all. So forget about the SSTB. There'll be no deduction given at all. Typically, why they are saying, because first the income is high, and secondly with professional services, the profit margins are always higher because there is no specific profit margins that you're working on. The way lawyers will charge is like, if the litigation is very, very crucial, they may even put $50,000 as fees. Typically, professionals will have more profit margins. Okay, but if you're running a trading business, you're buying and selling something, or you're, like there will be like maybe 10%, 20%, 15% margins. So you will still get a QBI deduction. We'll do the wage limit and we'll have to see how much it is, lesser of 20% or W2 limit, whatever that is. So all these calculations, the reason why I showed is that we need to see what phases these people are falling under, what phase in range, thresholds. And depending on that, maybe some is completely disallowed. Some of them we have to take what is the lesser. Here even SSTB is allowed. And here there are certain rules. If you're single, you have to, take your 157,000 is the income phase in limit and all, and we have to calculate based on that. Okay, we are not doing all this. I don't want you to really get, hung up on this thing, how this is coming, how that is coming. I mean, if you really want to deep dive into it, you can see that. But if you're using softwares, all the calculations will come automatically. Only thing what you need to do, or what we need to do, is make sure that QBI box is check marked. Make sure SSTB is check marked properly in all the places. Make sure if the W2 is issued, we are putting it in the right box in K1, that yes, there is a W2 issued. Then all the calculations will happen. If there is a W2 issue, but you forget to mention that, no QBI will come. Client will end up paying more. Okay. So let's go with that. Okay. So we'll stop here now, and we'll start with aggregation rules. Okay. We have seen how the QBI deduction can go even lower than 20%. 20% is the highest one can get. Lower than that, it can go based upon what category we are falling under. Okay, then any questions?